All of these things to me are peripheral noise. No, it's not. That doesn't change the structural problems that we have with the monetary system, with our indebtedness, with everything. But and we should hope for peace, certainly. But no, I don't think that changes anything at all. In fact, you could argue that when the war is over, you may see a larger, more concerted effort by the BRICS nations to focus on unity, to focus on trade. And we talked about last week, 40 plus countries have applied for the BRICS, Vietnam being the last. And their new payment system, which is now open to non-member nations, they haven't slowed down behind the scenes. They're just not as open about it anymore. And the Russian finance minister is all over the place, Lavrov, talking about this. And so peace is good, but it should not have anything really material to do, in my mind, with the price of gold. Really, it shouldn't. Even if it ended today, I don't see how it materially impacts the United States, the dollar, or any of the problems that are fiscally or monetarily in front of us.
Any comments from you on the concept that some retracement to Fibonacci levels is normal and healthy in a bull market?
100%. Richard Russell, I'll make it easy because the Fibonacci numbers, I don't know off the top of my head, but yes, that is true. Richard Russell always used to say at least a 50% retracement. When you see things move up that high, a 50% retracement is normal. And it is normal and healthy, with somewhat of a gold squeeze. It moved a little too fast. It was exciting. And, we were all thrilled by it and expected it to go straight up forever, but it won't be that easy, not even a little bit. But take a step back again. And you got Treasury Secretary Bessent saying that the bond markets are signaling it's time for the Fed to cut rates. Well, they want to go back to, more easy money and perhaps even quantitative easing. Again, this is very gold friendly. Powell didn't say flat out that he's going to abandon his dual mandate, but he hinted at it. In other words, they're caught. And they know it. We're caught between the ability to fight inflation and to keep rates low enough to stimulate the economy. You're seeing mass layoffs. You're seeing a slowdown in the economy. And so I think, what do you do? I think Trump wants lower rates. He wants a lower dollar, as we've seen. And now you have the Treasury talking about coming in and buying their debt as well, finding ways to buy older maturity debt. Again, this is all monetization. We saw the negative print on the GDP, right? And so the 2-year Treasury yield is 3.56 right now, but the federal funds overnight rate is 4.33. This is more of what we saw before. This is classic yield curve inversion. This screams of a recession coming, with inflation fears elevated already. May 7th is the next Fed meeting. A lot of this is done by design for optics, with the Fed meetings coming up and everything is okay, don't worry. But they want to lower rates. They want to lower rates not only on the front end of the curve, but even the 10-year, and stimulate. You're going to see a reignition of inflation. This is all very gold friendly. So, I think there are some big players that are caught in the futures market that would love nothing more than to extricate themselves from these positions. Seeing the metals market get knocked down like that and see all of these contracts closing out is not surprising to me. What is surprising is people's reaction, thinking that, maybe we should go from risk off to risk on. Absolutely not. I think that this is why, emotions very often get the best of us, and it's natural. I get it. It is emotional, but you got to take a step back and ask yourself, what, if anything, has changed? We're not saving any money on our indebtedness. In fact, we're going deeper and deeper into debt, even with Doge. So the indebtedness is still a problem. The fragility of the economy is still a problem. The geopolitical issues are still a problem. Nothing's changed. But what has changed is there's greater volatility in the market.
Now, look, I get it. You see gold and silver move up, then drop back, sometimes sharply. People panic. People second guess. You get that classic, maybe I missed it feeling, or maybe this was just another head fake. But I want to be really clear. These corrections are not the end of the bull market. They are part of it. They are necessary. They are healthy. And most of all, They are tactical resets that shake out the weak hands so the big boys can reload. You want proof? Just look at what's happening under the hood. Since November, the United States has become a net importer of gold. That hasn't happened in my career. Over 60 million ounces have moved into COMEX. That's not speculative money. That's not Reddit traders buying options. That's serious money buying the only Tier 1 reserve asset in the world besides US Treasuries. And what's happening in London is just as important. LBMA, which is supposed to be the most liquid gold market in the world, quietly changed their settlement terms. It used to be T+1, trade today, deliver tomorrow. That was their hallmark. Now, it's T+8 weeks. They're telling us it's a shortage of trucks and labor. Really? The Bank of England is short on delivery vans? Come on. The truth is, they're spooked. Why? Because of their rehypothecation problem. The float of physical gold in London is somewhere around 36 million ounces. That's what they can actually deliver. But the open interest, contracts that say, you owe me metal, is more like 280 to 300 million ounces. That's nearly a 10-to-1 leverage ratio. If even 20% of those contracts stand for delivery, the system breaks. It's the same with silver. There might be 260 million ounces in London that are unencumbered, but they're trading 2.9 billion ounces per day. That's 3.5 times the entire global annual mine supply. If that doesn't scream distortion, I don't know what does. And while all that's happening, people are out here saying, well, gold's up too fast. Maybe it's time for a pullback. Maybe? Sure. But zoom out. Take a step back. Gold is rising because trust in the financial system is collapsing. The Fed is boxed in. Treasury yields are inverted. The bond market is pricing in rate cuts while the Fed insists inflation is still an issue. It's a circus. And the only asset that doesn't have a clown behind it is gold. Think about this. We've got the 2-year Treasury yield at 3.56%, but the Fed funds rate is 4.33%. That's an inverted curve, folks. It's screaming recession, it's flashing red, and every time in history this has happened, a recession followed. Every single time. So what are the central planners doing? They're preparing the public for more easing. They won't say it yet, but they're laying the groundwork. You've got the Treasury Secretary talking about buying longer-dated debt. That's a fancy way of saying monetize the debt again. And what does that mean for gold? It's rocket fuel. We've already had a negative GDP print. Corporate earnings are rolling over. Layoffs are accelerating. So what's next? The Fed pauses, then it cuts, then it restarts QE. That's the only playbook they have. They can't let the system crash. They can't let interest expense spiral. So they'll print. And when they do, all of this volatility you're seeing in metals is going to look like a sneeze on the chart. And while we're here, let's talk about emotion. Because a lot of people get shaken out at exactly the wrong moment. You see the price dip and you think, I was wrong. You weren't. You were just too early or too easily rattled. Markets are designed to make you question your convictions. That's their job. They reward those who understand the fundamentals, not those who just follow the price action. Look, none of the structural issues have changed. The US is still $34 trillion in debt. We're still running $2 trillion annual deficits. Entitlements are exploding. Interest payments are now the largest line item in the federal budget, bigger than the military. This is not sustainable, and it's not going to be fixed with a press conference. The geopolitical backdrop hasn't changed either. If anything, it's accelerating. The BRICS nations are pushing forward with their own payment system. Vietnam just applied to join, and now that system is open to non-member nations. They're building parallel rails, quietly, strategically, and with long-term intent. This is not about headlines. It's about hard structure. And when it's complete, they'll flip the switch and opt out of the dollar system in bulk. And that's not all. The idea that a peace treaty or the end of a war is somehow going to reverse the global move toward de-dollarization is ridiculous. In fact, the opposite is more likely. Once peace returns, these nations will focus even harder on building a new trade framework. They'll use gold. They'll use commodities. They'll bypass the SWIFT system, and the dollar will lose more and more share of global settlement.
the most basic, simple way of describing is that central banks aren't going to go back to buying treasuries and selling gold. I think that from here on out, you're going to see more turbulence, more volatility, sharper swings, but nothing's really changed. In fact, I just think you have to not get shaken out. The bull wants to take as few people along for the ride as possible, and you have to keep your perspective. They try to tell us that this was the Chinese dumping like 1 million ounces of gold. Let's just put that in perspective. So first, when we talk about Chinese gold-backed ETFs, in the month of April, they saw more inflows than all of 2024. And that's just in the first 11 days of the month. When we talk about China dumping gold, first of all, their markets are closed right now until May 5th, which is very peculiar. In fact, this lends itself to making you think of conspiracy and of manipulation and of suppression during Chinese trading hours when their markets are closed. That's a clever trick. To me, that's very suspicious, to say the least. And Goldman Sachs' story is very suspicious. And I think the bullion banks were able to exploit the closures in the Chinese markets to smash the price. If you look at a chart, a continuous 24-hour chart, you see it go up every time it hits Chinese trading. It goes up and gets smashed as it comes into New York. Well, suspicious. Goldman talked about a 31-ton dump, but they didn't make any delineation between the Shanghai Gold Exchange and the Shanghai Futures Exchange. So I did a little digging. The Shanghai Gold Exchange delivers less than 4 tons a day. In essence, the majority, if not all of this dumping was done in the futures market. And so I think that that's important here. You're not seeing physical gold being sold off. You're seeing futures being sold. It's done for effect, for sure. Let's talk about what's happening here in the United States. We saw for the May contract in gold, 9,306 contracts stand for delivery. That's the second highest ever for a non-active delivery month. The silver May contract, 14,813 contracts stood for delivery. That's the second highest ever, just behind March's record delivery. And we're beginning to see these short positions that are closing their positions, and you knock it down, and a good way to close it. But it seems everything's settling for physical delivery. The other side of the short, the long, says, great, we'll stand for delivery, please. Who are those longs? We don't really know. But to me, this just exemplifies continued demand at the highest level. So I think people need to put things into perspective. It's been quite a run in gold. Silver hasn't even begun to blow out from its technical formation. I suspect it will, and probably much more so than what we witnessed in gold. But I would just simply say that it's going to be bumpy, but nothing has changed, not even a little bit. And with the Fed meetings and all the things that are happening, I think perception, this was a perfect opportunity for, if I had to guess, the Western bullion banks to knock the hell out of the price.
Let's pick up right where we left off, talking about how gold is being quietly reintegrated into the global monetary system, piece by piece, ounce by ounce, while 99% of the public is distracted by peripheral noise. We've seen the US become a net importer of gold for the first time in my career. That alone should stop people in their tracks. But when you combine that with record deliveries into COMEX, unprecedented delays at the LBMA, and major players like JP Morgan moving billions in physical gold, well, at some point, the smoke leads to fire. Now look, let's talk about this concept of revaluation, because this is where everything changes. This isn't some tinfoil hat theory anymore. This is baked into the structure. If you're the US government and you want to restore confidence in your debt, which is quickly becoming unbuyable by foreigners, how do you do that? You back your debt with gold. Not fully, not 100%. That's not realistic. But even partial convertibility, even a revaluation to market price, changes everything. It's like saying, hey, we're not going to default. You can hold our treasuries and know that they're backed by something real again. And if you let gold rise slowly, maybe to $4,000 or $5,000 over the next year, and then you peg new treasury issuance to that level, you just re-injected trust into the system. I mean, think about it. Gold has doubled the performance of the 10-year Treasury since the year 2000. It has no counterparty risk. It can't be sanctioned. It can't be defaulted on. And now that it's a BIS-recognized Tier 1 reserve asset, it sits on the same level as Treasuries from a central bank perspective, but with none of the liabilities. And here's the kicker. All of this is happening without media coverage. That's the part I find most surreal. Gold is up near $3,500 an ounce, and you'd think it was still stuck at $1,800 if you turned on CNBC. They're still talking about tech earnings or whether the Fed will do a 25 basis point cut. Meanwhile, behind the scenes, the foundation of the next monetary system is being laid. And this is where I think we need to connect the dots even more directly. We've got a gold revaluation account on the Fed's balance sheet. It hasn't been marked to market since the 1970s. But if they revalued it today, just market to market, nothing extreme, that one line item could absorb trillions in debt just by assigning today's gold price to the U.S. gold reserves. And that's before we even talk about pegging future Treasury issuance to gold. Now ask yourself this. Why would J.P. Morgan deliver $4 billion in gold to COMEX in February? Why would Trump tweet, "He who has the gold makes the rules"? Why would we suddenly see unprecedented delays in London? Excuse after excuse about trucks and staffing, all while delivery demand rises? Because the insiders know they're not reacting to price. They're positioning for system change. And listen, I'm not saying tomorrow morning we're going to wake up to a Bretton Woods 2.0 press release. This stuff doesn't happen with a drum roll. It happens quietly. And then suddenly, that's how all monetary resets go. The dollar didn't lose gold backing on live television in 1971. Nixon called it temporary. People shrugged. But 50 years later, we've got $34 trillion in debt and no anchor. And now we're at the end of the road. So what happens next? Let's sketch the playbook, because this is where it gets really important for investors who still think they're early or that gold is too expensive. Step 1, the Fed pauses. Maybe they even cut. Inflation doesn't go away, it reignites. The Treasury starts buying its own debt again. That's QE, folks. Step 2, confidence erodes in Treasuries. Foreigners stop buying. The Fed becomes the buyer of last resort, again. Rates are artificially held down. Step 3, revaluation talk surfaces, quiet at first, then louder. Gold rises to $4,000 or $5,000, maybe more. Treasury releases a new note, backed by 10% gold, 20% gold, who knows? But the headline is what matters. Redeemable in gold. That's a nuclear weapon of confidence restoration. Step 4, the dollar doesn't die, it morphs. It becomes part of a dual system, floating fiat for everyday use and gold-pegged notes for sovereign-level settlement. At the same time, the BRICS bloc rolls out their own gold-backed settlement unit, and suddenly gold is no longer a commodity. It's currency again. This is not fiction. This is already happening in pieces. Now here's where I want to bring it home. If you're hearing this now, you still have time. But the window is closing, and I'll say it plainly. If you're waiting for mainstream confirmation before you act, you're already late. Gold doesn't need you to believe in it. It doesn't care about your feelings. It's not reactive. It's not driven by TikTok trends or press releases. It just is. It's the only monetary asset that has outlived every government, every fiat currency, every crisis. And in the next crisis, it won't just survive, it will lead. Same with silver. Same with Bitcoin, if you're on that side of the fence. The point isn't which one you choose. The point is that you choose something that isn't dependent on a dying system. And don't let these price dips fool you. In fact, the recent pullback was textbook. Go back to Richard Russell. 50% retracements are normal and healthy in bull markets. They shake out the froth, they give the big players an entry, and they set the stage for the next leg higher. You think gold is overbought at $3,400? Wait until it's $4,700 and you can't get physical delivery for 3 months. Wait until premiums explode. Wait until the ETFs decouple from the underlying. Wait until the Fed issues a treasury backed by revalued metal and your fiat savings don't qualify. Because make no mistake, once gold gets reintegrated officially, the rules will change. You may not be able to convert your dollars into that new gold-backed system unless you already hold metal. That's the twist nobody's pricing in. The same people who are asleep now will be told, yes, there's a new system, but you had to own it before. You can't buy in now, it's closed. That's the wake-up call. And here's the irony. When that day comes, gold won't feel expensive. It'll feel cheap, because you won't be looking at price anymore. You'll be looking at purchasing power. That's what the smart money's doing now. They're not buying gold because they think it's going to $3,800. They're buying it because they don't trust the world's governments to keep their promises. And honestly, that's the smartest bet you can make in 2025. So what do? You do what the central banks are doing. You buy gold, you take delivery, you store it where it's safe. You don't trade it, you don't overthink it, you just own it. Because when the system changes, and it is changing, you want to be holding the asset that doesn't blink, doesn't default, and doesn't need permission. That's gold. And we're watching its quiet return to center stage in real time.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.